Alright, I'm going to get on replying to some of the specific questions that have been asked. If I don't get to your questions today, it's not that I'm not going to get to them. I just basically chose to start with these because they were simple and they were more 101. I'm basically ordering the questions in nature of tutorial. The next one I'm going to be doing is actually the one asking about money trees and so on, but I'm not doing that one today, at least not in this vid, because somebody was asking some very 101 questions, and they asked 4 questions. I'm going to go through all 4 of them as best I can. Granted, 2 of their questions are just basically asking how to do math, because they, I guess, aren't familiar with the equations used. So those are very simple. The other ones are very subjective, and I don't want to lead people astray, so I'm going to cover them in the subjective nature they are. But they ended their questions with, sorry if they're dumb questions, apologizing that they're new to Forex. Are your questions very 101? Very, okay, I hope this doesn't sound rude, Forex kindergarten? Yes. Only dumb question is one you don't ask so you can stay in ignorance. So never be afraid of asking a question. I'm sure if you're asking these, there's other people who have the same questions. So, basically your questions, why very 101, are basically, so how exactly does Forex work and how does this transaction work? But I'm going to answer them a little out of order because it's going to be a lot easier just to cover the rudimentary ones. Your second question was, how does leverage work? Basically, when you open an account with a broker, you are granted the ability to buy on margin. Your deposit with the broker is providing liquidity to the market. So you are allowed to leverage that liquidity in exchange for providing it. It's basically an instant line of credit. A common margin, aka leverage, you will see in Forex is 50 to 1. For every dollar you put in, you can buy 50. This example here, we're saying you put $2,500 in the account. Okay, so $2,500 times 50 means you have the ability to secure $125,000 worth of position for a deposit of $2,500. Forex is pretty much the market you can do that in, and that's damn useful. Let's do this in principle and apply it. Let's say you buy 4 micro lots of the euro dollar. And it's the current price of the euro dollar, or the price you set either a stop or limit to execute at is $1.37. You may be buying, you may be shorting, depending on what's going on. Personally getting around $1.37 right now in the euro. Depending on how the market's behaving, if I'm doing trend trading, I'd be more interested in. Anyways, I'm not going to go into that right now. But 0.04 lots times 100,000 units per lot. A standard lot in Forex is 100,000 units, at least for currencies, which is what the Forex market is. So when when you execute an order, you're going to have a volume of trade you want to do. 1.00 is saying you want to buy or sell 100,000 units of currency X. In the case here, we're dealing with the euro dollar, which is the price of the euro paired against the price of the US dollar. In Forex, everything's paired in currency pairs. So the math would be 0.04 times 100,000 times the $1.37 price. I've included all the units so you can see how the math screws out. Units per lot cancels out lots, and dollars per unit cancels out units. So your result is dollars. For those of you who have a mathematics engineering background, anything like this, I'm sure at some point you had a science teacher that grilled units. Check your units before you put it into the calculator, into you to death. And that applies in markets too. So if you have any doubts you're doing your math right, apply the units and apply basic grade school mathematics to the units. And the result there is $109.60 on margin. So at 50 to 1 margin, because you divided it by 50, because you have a 50 to 1 ratio, you spent $109.60 and you secured 4,000 euros. $4,000 worth of euros. Oh, okay. You secured 4,000 euros. So that would be 4,000 times 1.37. Basically, that's $5,480 secured for 109 bucks. Congratulations. So kudos. Now, the third question they asked was, what are the mathematical equations used to calculate how much to risk and where to put stops? I want to quantify something before I go through this example. How much to risk is entirely up to you. I'm going to give a little bit of free advice here. A lot of traders who have had success in other markets come to Forex and they can't make heads or tails of it because they try and apply their loss-reward ratios from other markets to Forex. Forex is a volatile market. Currencies go boop, 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 boop. If you are not giving your position enough rope to move with the market, I promise you, every single one of them will trigger your stops before they can carry themselves to profitability. Many of them may be very good trades. You may be 100% right about what's going to go on, and you will get stopped out because you did not give it enough rope. One thing that throws a lot of people for a Louis in Forex is they have to actually let their position move. If you're not going to let your position move, if you're not going to let the market move, if you're not going to let your liquidity and equity position move so it can carry your trade to profitability, Forex is not a market you should be in, because you cannot apply the standard risk-reward ratios with arbitrary mathematics like you can in some other markets. You have to look at the currency pair you're trading with and look at how it's moving, and you better give it enough rope not to hang itself with. Now, that being said, so really it's completely arbitrary. It's based on your analysis of the market and where you think you need to be able to let it go. Now I'm going to walk you through the math, because using the equation I've given you above and the equation I'm giving you down here, if you are at least adequate at math, you should be able to adjust them accordingly to suit your needs based on how you're trading. Carrying on with our example of the 4 micro lots above, let's say we wanted to limit our losses to $500. Well, the price at the time of execution is $1.37. So, assuming it was a buy position that we executed, we can afford for the price to be reduced until the point that we've lost $500. So $1.37, I left the dollar sign off so the units aren't going to match, but I left the dollar sign off at the end too, so we're okay. $1.37 minus $500 divided by 0.04 lots divided by 100,000 per lot. Lots cancels out. Left with things, but I left the dollar signs off on the front and back. So, we entered at $1.37 expecting the price to go up. and we can afford for that price to drop to $1.24,500. When the price hits $1.24,500, those 4 micro lots will lose $500. They will have lost that much money. If you don't want to lose more than $500, that's where you set your stop out at. But to stress the point I was covering earlier, don't execute your trades based on a risk-reward ratio thing like you would in some other markets. Look point blank at the euro dollar and what are the realistic odds of it hitting a price lower than $1.24,500 on the way to being a price higher than $1.37. If the odds are high that it's going to do something like hit $1.22 or $1.20 on the way to hitting $1.38, there's a few things you want to consider there. Maybe you should be selling instead of buying, because that's a hell of a lot more move. And so, but if you are intent on doing a buy, you might want to readjust your volume so you can afford that lower price. Because if you've really committed to you can't lose more than $500 on this trade, then something's got to change here for that to make sense. Again, this is just arbitrary. This is explaining the math, which is what this person asked me to do. They wanted the mathematical equations. But, and how much rope you want to give yourself and what you want to do is completely arbitrary. There's a method of trading in which you're always going with the flow of the swap, which means you're always trying to short the euro. You're always trying to long the Aussie dollar, because while you wait for the trade to carry, the swap is paying you. Okay, that's a useful form of trading. But you better be giving that thing enough rope for it to carry all the way through while you wait for your longs. On the other hand, maybe you just want to trade the direction the market's going at the moment, rather than, it's not. But there's multiple ways to trade. There isn't a right or wrong way to trade. It's just what you want to do. I'm getting more into mechanics and answering the other question at that point. But this hopefully answers the question of how does leverage work, which explains that it's basically a line of credit for making your deposit with the brokerage. And we have 2 equations up there. One, basically just saying your maximum purchase limit, and one walking through buying, opening a position on margin. In the case was showing up there, it's a buy. And setting stops on that same position in accordance with the max amount of money you want to lose. Applying these concepts is more important than setting arbitrary analytical things. The fact is, there isn't ironclad math that governs. You do this, and risk that much, and do this, and follow this ratio, and these golden ratios will guide you to profit. With all due respect, if it worked like that, everybody with a computer would be a trillionaire. It doesn't work like that. You have to adapt on the fly to what the market's doing. It's just the way it works. But you need to understand the risk you're taking on, and that is governed by the equations shown on the screen here. Now, they asked 2 more questions. One of them was two-faceted. They wanted to know what currency pairs to avoid and which currency pairs I have success with. I'm going to answer the first one first. You should avoid any currency pair you can't make heads or tails of. It doesn't matter if somebody else is advocating it or having wonderful luck in it. If you can't figure out why it's moving the way it's doing and predict what it's doing, stay the hell away from it. Don't touch it. Leave it alone. As far as for what pairs I have success with, I'm hesitant to answer that in detail, because if they're pairs you're not going to have success with, I basically told you this is the good shit, and you can't make heads or tails of them, and I've done you a huge disservice. Usually the euro dollar is pretty much a safe bet, which is why I used it in that example. It's a good place called start. Why not everybody understands the euro dollar? It's a good place to get your training wheels, usually. And there's usually many opportunities in a day in the euro dollar, so it's a good learning pair. Not every single day, but very rarely have I gotten skunked by the euro dollar. I know people who, like, the same way I'll trade the euro dollar, they'll trade something like the Aussie yen just because they understand it inside and out. It's anything you can trade and get a good feel for, that's what you should be trading. And anything that doesn't meet that criteria, that doesn't match your trading strategy, stay away from. Just because somebody else is having luck in it, do not chase the money. Do not play follow the leader. Do what makes sense for you, please. And it's the same thing with the broker. They asked what website/broker to use for trades, and they wanted to know two things: most trusted and potentially profitable. Me personally, I won't touch a broker unless they have Metatrader, but I like Metatrader. Metatrader is the same no matter what broker I go to, so that's one of the things I look for. I do deal with multiple brokers. I'm not going to recommend any of them here because they match the way I trade and they're set up well for that. Comparing brokers on that context is a very apples to oranges thing. You may want instant execution. You may not care about market execution or instant execution because your trading strategy may only require you to place stop or limit orders, and therefore a better broker to you is one that, in exchange for not offering market execution or instant execution orders, they give you a much smaller spread. So you can it's easier for you to make profitable trades that are more profitable. There are a lot of pros and cons to broker. What you want to look for is that they match the way you trade. They have good uptime, and they use the platform you want to use. Don't try and fit a square peg in a round hole when it comes to the broker. Find one that's a good match for you and go with them. Which one that is, that varies on, are you a scalper, are you a swing trader, are you a hybrid trader, do you do basket trading, do you trade weeklies, there's so many factors that go into that. I'd be recommending what's good for me, not what's necessarily good for you. It's not that simple, I'm sorry. Download the demo, make sure it works for your trading strategy once you've got one developed, and then give them a whirl. That's the process for picking a broker. If you hit issues in the demo, move on. But no, they're not dumb questions. They're just basic. Basic would have been a better word. Hopefully, if anybody else was wondering this, we've answered it for everyone. I am going to say if anybody else asks these questions or very similar questions, I'm going to refer them to this video from here on out, because I'm not going to spend time re-answering the question, re-answering the question, re-answering the question. Although that seems to be the arguments we get in with all the metalheads. They'll ask the same question 8 dozen ways because you're not giving them the answer they want. They want to hear about how they're getting rich in gold and silver, and they're not. So that's that. So I have time later tonight. I think I'll do the money tree one too, to begin to answer the strategies and other things. But basically the question that was asked was, they want to hear more about my strategies and setting up money trees, etc. Well, those aren't really one question. A little tiny facet in the corner of what I call a money tree is my investing. But a money tree is actually how you handle your capital. It's you get money, what do you do with it? You have choices. You can do a lot of things with it. And do you make choices that help you or hurt you? That's a money tree. And it either grows or it self-destructs. To explain that concept would require going through various types of money trees. People just tend the one I advocate and the one I prefer, and then the one that versus what metalheads do and versus how the average person allocates their capital. You have to get that in order first before you try and apply on any of the individual strategies I do, because some strategies require different capital allocation than others. So we have to go through that concept first. Next week I'll do the update, because inflation comes out on the 15th, and I'll go from there. As far as... No, I'll get into that in that video. So, for now, peace out all.